Here is the striking number. The US dollar index is trading around 99.00 today, on Wednesday the 26th of August, 2026, yet it cannot break back above its 200-day simple moving average, which sits just above 99.00. That is not a coincidence. For a week now, every minor rally has been capped by that line. The index is down 0.75% on the month and more than 2.5% below its late July top. In plain terms, the 200-day average is acting as a ceiling, not a floor, and that tells you the broader trend remains bearish. The trigger came on the 19th of August. The US Treasury announced an increase in government bond buyback operations. That may sound technical, but markets read it as a form of dollar debasement. The dollar index immediately closed 0.86% lower, just beneath 98.80, its weakest close since mid-May. Then on the 24th, TD Securities strategists said the dollar has re-entered a bearish regime after that announcement pushed the index below its 200-day moving average. Added to this, US data has been soft. July retail sales fell 0.6% against expectations of a 0.1% gain, and non-farm payrolls surprised to the downside. The result is that markets have cut the odds of a September Federal Reserve rate hike to about 30%, down from above 50% a week earlier. Here is the practical impact. The 14-day relative strength index is at 35, just above oversold territory, which means downside momentum is still dominant, but a short-term bounce cannot be ruled out. The 9-day average directional index is at 49.92, with a negative directional indicator at 39.80 against a positive reading of just 6.99. That is a very one-sided market. For traders, 99.00 has been giving way intraday, so the first real support is last week's low just above 98.50. On the upside, the 200-day exponential moving average near 99.50 is resistance, and the 50-day average parked on the 100.00 handle creates a significant resistance band. In short, rallies are being sold, not chased. Looking ahead, the evidence points to consolidation under pressure rather than a clean collapse. Brown Brothers Harriman analysts see the dollar supported above the 200-day moving average, at 99.15, and argue there was no fresh catalyst behind the latest broad-based slump, so the index should stabilize around that level. OCBC strategists note that policy uncertainty and Federal Reserve reaction risk are constraining dollar gains, even while higher U.S. real yields and a resilient economy limit the downside. MUFG also sees consolidation after a modest rebound. The key test remains the 98.50 support. If that breaks, the bearish structure opens up further. If not, expect a choppy range between 98.50 and 99.50. So the takeaway for today is straightforward: do not fight the 200-day moving average while it continues to cap every rally. The dollar's bearish regime is being driven by Treasury buyback concerns and repriced Federal Reserve expectations, not by one random headline. Watch the 99.50 resistance and the 98.50 support. A close above the 200-day average would signal a possible short-term base, but until that happens, the path of least resistance is still lower.